Here's where most retirement rankings go wrong. They'll tell you the best state to retire in based on weather, golf courses, how many hospitals, the cost of living sometimes. They'll do crime statistics, walkability, museums, are there volunteer opportunities, whether there's a pickleball court within 3 miles of your house, which is fine. But I'm a tax attorney, so I'm asking a different question. If you've spent 30 to 40 years building up a nest egg, which states let you keep it? Which states quietly pick your pocket on the way out? Because let's just say I'll use wallet hubs. This 2026 list says the top 5 retirement states are Wyoming, Florida, South Dakota, Colorado, and Minnesota. Minnesota at number 5. Now I'm not picking on Minnesota, beautiful state, great health care, great quality of life. Wallet Hub ranked it highly for those reasons. In fact, it was number 1 for hospitals. So if you have lots of medical issues, Minnesota looks great. But from a retiree tax standpoint, Minnesota is one of the last states I'd want to be in. And that's the point of this video. The best states to retire in really depends on what you're measuring. And if you're measuring hospitals, Minnesota looks great. If you're measuring how much of your IRA, your pension, Social Security, your house, your state, that you, then your heirs get to keep, Minnesota starts looking a whole lot different. So today we're going to go and look at this from a very narrow lens, and that's taxes. Not politics, not weather, not where your grandkids live. We're just looking at taxes. The 5 worst states to retire in from a tax standpoint, the 5 best, and the trap that can get you even if you're in a good state. I'm Toby Mathis. Let's jump on into it. All right. There's really 4 tax levers that matter to retirees. Lever number 1, retirement income. Does the state tax your IRA distributions, your 401k, your pension? Because that is the money you already paid to build, right? You've already got nailed on it. Here's the part that most people miss. You don't need to be in a no income tax state to win this game. There are states with an income tax that still leave retirement alone. For example, Illinois, Iowa, Mississippi, Pennsylvania, they all have income taxes, but they generally exempt traditional retirement income. That means the headline, no income tax, that's not enough. You really have to ask, does this state tax my type of income? Number 2, Social Security. Most states do not tax it. As of 2026, I think there's still 8 states that do tax it in some form. I think it's Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont. Now, some of those have exemptions. Some phase it out based on income. Some are really there, they hit only higher income retirees, but the point is still, your Social Security check is not treated the same everywhere. It's not universal. Number 3, death taxes. This is one my audience should care about the most because this is where the states punish people who did everything right. They saved, you invested, you bought a house, you build a huge stock portfolio, maybe you own a bunch of real estate, you're following infinity investing and you've built all these things. Maybe you have life insurance, maybe you had a business that's grown. You don't think of yourself as ultra rich, you just did what responsible people are supposed to do. And then you pass away and the state says, thank you, we're going to take a cut now. The federal estate tax exemption in 2026 is $15 million per person. So for a married couple with proper planning, it can be $30 million. For most people, the federal estate tax is not the issue. The state estate tax is the issue. In some states, exemptions are shockingly low, like Oregon. It's $1 million that's exempt. Then you start getting hit with the state tax when you pass. Ugh, that's crazy. Lever number 4, property and sales tax. And this is where people get fooled by no income tax states. Texas, that's the classic example. They have no income tax, they have no estate tax, which is great, yes. But property taxes can take a real bite. Texas homeowners pay, I think the median is over $4,200 in property taxes in 2026. based on the state's median value of a home. I think it's like $283,000. There's an effective rate around 1.6%, and that's the 6th highest nationally and roughly triple the national median. Tennessee is another. They have no income tax, no death tax, but the sales tax is high. Tennessee has an average combined state and local tax rate of 9.61%. 7% plus they have local rates. They go up to just under 3%. Second highest in the nation. Florida is another one people need to understand. No income tax, no estate tax, but man, homeowners insurance, flood insurance, HOA fees, condo assessments, they can really eat up a lot of your savings. In Florida, for example, the average insurance cost per property. So the question is not, does this state have one low tax? The question is, how many ways does this state have to get into my pocket? A retiree with $300,000 home spending $30,000 a year taxable goods pays roughly $6,700 a year in property plus sales tax in Texas. It might be $4,700 a year in Florida, $4,100 a year in Tennessee, which makes the point that no income tax doesn't settle the question. Where the state collects is instead what determines your actual bill. So now we have a framework. Now let's get into the results. First, let's count down the 5 worst. All right, what's number 5? Massachusetts. I'm just going to write Mass. Massachusetts does exempt Social Security, so a modest income retiree may not feel the pain immediately, but Massachusetts is a trap for people who build wealth. It taxes most retirement income. It has a flat income tax. And then if you have a big income year, maybe a business sale, a large IRA distribution, or a major capital gain event, you can run into additional millionaire surtax. And then there's the estate tax. Massachusetts has a $2 million estate tax threshold, which means like their estate tax goes as high as 16%. And you only have an exclusion of about $2 million. And $2 million sounds like a lot until you add up, you got a paid off house, retirement accounts, taxable brokerage, life insurance gets added into there. Maybe you have some rental property. So this isn't like billionaire territory. This is a responsible saver in a high cost state territory. And Massachusetts catches the middle class millionaire. Number 4, New York. New York. Bet you couldn't have guessed that one, right? New York is interesting because it looks friendlier at first glance than it really is. Social Security isn't taxed, government pensions may be exempt, and if you're over 59 and a half, New York gives you a limited exclusion on certain retirement income. So if you're a modest retiree, New York may not be the worst, but if you built real assets, New York has one of the nastiest estate tax traps in the country. It's called the estate tax cliff. In a normal estate tax system, you tax the amount above an exemption. New York says, nah, not so fast. For 2026, for example, New York's estate tax exclusion is $7.35 million. But if your state goes more than 105% of that exclusion, which is just 7.717 million, so 7.7 million, a little bit over that, the exemption can literally disappear. And the estate taxes the entire estate from $1. It's not like it's just an amount over, they go back and get it. So think about that. You're not just taxed on the excess. You can lose the exclusion entirely. A little bad planning, a little market growth, a life insurance policy you forgot about, or a house that appreciates can push that estate right over the cliff. And that's the kind of tax rule that punishes people for being close. Number 3, mentioned this before, Oregon. Ooh, Oregon does not tax Social Security, so I'll give it credit due for that. But that's about where the good news ends, because Oregon taxes most retirement income. The income tax brackets are high compared to most states, with the top rate near 10%. And then Oregon has one of the lowest think it is the lowest, estate tax thresholds in America at $1 million. That's $1 million. And then you start getting nailed. In 2026, the federal exemption is $15 million per person, but Oregon says, nah, they start at $1 million. That means a person can owe 0 federal estate tax and still get hit by Oregon's state estate tax. If you have a home, an IRA, a brokerage account, maybe life insurance policy, you get there quick. So Oregon is beautiful, no sales tax, great scenery, but from a retiree tax standpoint, it can be brutal. Number 2, Vermont. Vermont is another state where the postcard looks better than what's going to be your tax return. It taxes Social Security for some retirees, depending on income. It taxes retiree income with very limited deductions. It has high property taxes, and it has an estate tax. The Vermont estate tax exclusion is $5 million, and the rate is a flat 16% of the amount above that exemption. Now, is Vermont worse than Oregon on a pure estate tax threshold? No, Oregon's threshold's way lower. But Vermont pulls more levers at once. It hits the income, Social Security, property, estate taxes. So it's a beautiful place to visit, but expensive to grow old in. And what's the worst? Oh, we were talking about this. Minnesota. And this is where I want people to understand the difference between being a retirement state, one of the best to retire in, versus the best state tax for retiring in. So from a tax standpoint, it's very different, because WalletHub ranked Minnesota at number 5 overall in 2026. Why did they do that? Because of healthcare. They were number 1. Quality of life, they were really high, which is great. That's their methodology. But from a tax attorney standpoint, Minnesota is one of the worst places in America for a successful retiree. Minnesota taxes most retirement income. It partially taxes Social Security depending on your income. Its top income tax rate is close to 10%. I think it's 9.85. And it has an estate tax that applies to estates over $3 million. That's a trifecta. They tax you while you're alive, they tax your Social Security, they tax your estate when you're gone. If you're a retiree who did everything right, you saved in a 401k, you built an IRA, you paid off a house, maybe accumulated some investments, Minnesota has multiple ways to get into your pocket. And that's why Minnesota can be a great quality of life state and still be a terrible keep your money state. Those are 2 very different questions. Now, honorable mention, more states, California, no estate tax. It does not tax Social Security, but it taxes IRA and pension income. High income retirees can get hit hard. And let's be real, they can be nuttier than fruitcake with the wealth tax proposal. Like, no thanks. California, very expensive state to be in if you're a retiree. New Jersey, Social Security is not taxed, but property taxes, boom, they nail you, and there's an inheritance tax. Ooh. Connecticut and Rhode Island both have improved, but they sit in a watch carefully category because Social Security taxation rules, estate tax issues, and property taxes. Illinois is another one. Retirement income is generally exempt, which is a big win, but property taxes and estate tax issues mean you have to run the full math. It can be brutal. It depends on who you are, but you got to run those numbers. Now let's flip this around. So we have the worst. Now what about the 5 best states from a tax standpoint? Let's start with number 5, Mississippi. Mississippi. This is a curveball, right? WalletHub ranks Mississippi near the bottom for overall retirement. In 2026, I think WalletHub put it at number 48. Why? Because of healthcare, quality of life, other non-tax factors. But taxes? Mississippi is actually very friendly to retirees. It exempts Social Security, It exempts pensions, it exempts 401ks and IRA distributions. There's no estate tax, no inheritance tax. The property taxes are low. So Mississippi proves the biggest point of this video. You cannot just read a best states to retire in ranking and assume it answers your question. Wallet Hub may say Mississippi is a bad retirement state overall, but a tax attorney may say for the right retiree from a tax standpoint, Mississippi is fantastic. Both can be true. How about number 4? Ooh, Florida. See if I can actually write an I. Florida is the retirement capital of America for a reason. Has no state income tax, has no tax on Social Security, has no tax on IRA distributions, no tax on 401ks, no tax on pensions, no estate tax, no inheritance tax. And this is really why you see people from New York, New Jersey, Connecticut, Illinois, Massachusetts, and California. They keep heading to Florida. But I want to be very clear. Florida is tax friendly. That does not mean Florida is cheap. This is where people get sloppy. They say, I'm moving to Florida because there's no income tax. And they forget to run the full carrying cost of a house. Property taxes in Florida are not the worst in the country, but they're still pretty bad. Florida is not New Jersey. It's not Illinois. It's not Texas. Florida also has homestead protections. It can help long-term residents if you have any liabilities out there. They can't touch your house. But insurance, ooh, homeowners insurance in Florida can be brutal, especially if you're near the coast. Then you add in flood insurance, wind coverage, HOAs, special assessments, especially if you're familiar with what's going on with a lot of the condos. If your building needs repairs, it can be, whoom, suddenly the no tax state, man, it doesn't look so cheap anymore. It's not free. So Florida is still one of the best states from a tax standpoint. But before you move there and say, just that's your reason, run the numbers, not just the income tax. Ask what's the property tax going to be, what's your homeowner's insurance going to look like, what your flood insurance is going to look like, what are the HOA dues, what are the likely special assessments if you're buying a condo especially. Because a retiree who saves $20,000 in state income tax but pays $12,000 more in insurance and HOA fees, you didn't save $20,000. At most, you saved $8,000. And in some coastal areas, you may not have saved anything at all. So Florida is great for taxes. Florida is not always great for the cost of living and the carrying costs of a property, and that distinction matters. Number 3, South Dakota. No income tax, no tax on retirement income, no estate tax, no inheritance tax. And for high net worth families, South Dakota has another advantage. It's one of the premier trust jurisdictions in the country. I mean, I love Nevada, but South Dakota is right there on almost every list. It's number 2, and it's very, very close. So if you want dynasty trust planning, asset protection, directed long-term planning trusts, this is really a great state as part of that world. It's not just a retirement state, it's a planning state. So Wallet Hub also ranks South Dakota really high overall. I think it was number 3. So this is where, like, our broad rankings, Wallet Hub and us, we start to cross over because the tax actually starts to line up. Number 2, my state, Nevada. Nevada is home for me, so I'll keep myself honest. Nevada has no state income tax, no tax on retirement income, no estate tax, no inheritance tax, and property taxes are among the lowest in the country. And that's a big deal for retirees because property taxes don't care whether your portfolio is going up or down. It could be crashing, doesn't care. Doesn't care whether your dividends got cut. They certainly don't care if you're in a bear market. They show up every year. Nevada's not perfect. Sales tax can be a little higher depending on the where you know what you're comparing it to. Healthcare access can also vary. There's a shortage of doctors, and if you hate the desert, well, you're going to have a problem with Nevada. But from a tax standpoint, Nevada is really hard to beat. Just ask all my neighbors who moved here from New York and California. They're so happy here. They're like, gosh, it's so cheap. And remember, it's a dry heat, so it might be 200 degrees out, but don't worry, you're not going to sweat. You're just going to. All right, number one. What's the number one state from a tax? This is, if you guys watch this channel, you know where I'm going to go. Wyoming. It is the gold standard, guys. No state income tax, no tax on retirement income, no estate tax, no inheritance tax, low property taxes, low sales tax compared to most states. Their government has spending in check. They don't go crazy, so they're not going to try to hit all the rich folks. Wallet Hub also ranked Wyoming number one overall in 2026. And this is one case where the tax side and everything else, they align. Wyoming does not pull the major retiree tax levers at all. It doesn't tax your IRA, it doesn't tax your pension, it doesn't tax your Social Security, it doesn't tax your estate, and it doesn't hammer your house the way other states do. But what's the trade-off? Let's be real. Wyoming is sparsely populated, which means healthcare access outside of larger towns, that's going to require some planning. If you need specialists, airports, major hospitals, urban amenities, you need to choose your location very carefully. But if we're talking about just tax, pure retiree tax math, Wyoming's number one. Now, how about some honorable mention states? I didn't put them on the list, but Tennessee's there, no income tax, no death tax, but it does have high sales tax. Texas has no income tax, no estate tax, but property taxes can be a catch for you. New Hampshire, no income tax on wages or retirement income, no sales tax, but property taxes can still be high. And now let's talk about the trap, because this is where people think they've won and then they get crushed. Moving to a tax-friendly state is not a driver's license trick. I can't just go buy a condo in Florida, spend 3 weeks there and say I'm a resident there. It's not putting a Nevada address on your stuff, on your checking account, when in real life you still live in California. This is called domicile, and domicile means where is your true home. High tax states know exactly what's happening. They know retirees are leaving, they know high income people are leaving, they know estates are leaving, and they audit those folks that leave. New York audit residency, California audits residency. Go read Hyatt versus California State Board of Equalization. If California literally sent agents into Nevada to break into the home of somebody who moved out. Not his California home, no, they went to Nevada. I think we ended up with 3 U.S. Supreme Court decisions out of that whole dispute. There was multiple cases. I think it was a 25-year war, and I think California spent over $25 million to pursue the guy that moved out, Hyatt. And Hyatt mostly won, but it was a very, very costly victory. 25 years, millions of dollars. He's never going to get that back. You do what you want. No. You don't want that to be you. Other high tax states do it too. And they don't just look at where you say you live, they look at where your life is. Where do you sleep? Where is your house? What is your utility usage? Because they'll just measure what your utility bills are to say where you spend more time. Where's your spouse? Where's your doctor? Where's your primary dentist? Where do you vote? Where are your cars registered? Where's your business? Where's your church? Where's your country club? Where are your pets? Where are your valuable items? Where are your estate planning documents drafted? Where do they say you live? Where do your credit card statements say you actually spend your time? Like they'll look at what you charge. Because if you say, hey, I moved to Florida, but everything meaningful in your life is still in New York, New York's going to say, no, you didn't move to Florida. You're still here from a tax perspective. We're still going to tax it. And they win that argument. They can tax your income. Worse, they can argue your estate is still domiciled there when you died if they want to nail it with the estate tax. So if you're going to move, move. Change the driver's license. Change your voter registration. Move your doctors. Move your banking relationships. Update your estate documents. Track the days that you spend in which place, if it's close. Sell or genuinely change the use of the old residence. Move the center of your life to that state. A real move will save on taxes. A fake move, hey, I just bought a little condo in this state. I know people do it here in Nevada. Californians would go buy some crappy little condo and say, that's where I live. That creates an audit, and you're going to lose. So here's the takeaway from all of this. Wallet Hub may say Minnesota is a top 5 retirement state because of health care and quality of life. Tax attorney may say Minnesota is one of the worst states for a successful retiree because of taxes, retirement income. They could tax your Social Security. It has an estate tax. Wallet Hub may say Mississippi sucks. It's near the bottom. Tax attorney may say Mississippi is one of the best because it exempts retirement income and has no estate or inheritance tax. Both can be true because they're answering different questions. The question for you is, what matters most to you? If you're looking for the best hospital system, use one list, like really look at that. If you're looking for the best weather, use a different list. And if you're trying to keep more of your retirement income and pass more to your heirs, run the tax math. Because your state sets the rules of the game, your planning determines whether you win using those rules. And where you retire can be the difference between your money going to your family, your lifestyle, your charities, or the state revenue department. If you got a state thinking that you're thinking about moving to, drop it in the comments. We'll take a look and see where it is on the list. Say, I'm in California thinking about Nevada, or I'm in New York, I'm thinking about Minnesota, or I'm in Minnesota, I'm not happy with this video at all, Toby, or you really ticked me off. Do you think I missed something? Put it in the comments too. Like and subscribe. I'm Toby Mathis. Keep more of what you earn. Good luck.